Hey, Sylvia. Hey, everyone who's listening and tuning in. My name's Shai Balor. You might know me as Stock Savvy Shai on Twitter. And we have the fortunate guest of Sylvia Jablonski, CEO of Defiance ETF. How are you doing today?
Good. Thanks for having me, Shai. I'm excited to be here.
Yeah, I mean, thanks for hustling over. I know we had a little wires cross on our time for this call, so appreciate you taking the city bike to get to fit this time.
Absolutely. Anytime.
So we can get right into it. Before we begin, like, can you share with us your journey in the financial industry and what led you to your current role as CEO and CIO of Defiance ETF?
Yeah, sure. I'd be happy to. So, I was always kind of interested in markets, like even as like a little kid and whatnot. So I sort of knew that I would major in something related to finance or business or something like that. So I did. I studied finance and econ, and kind of took it, like did the MBA and all that kind of stuff. And out of school, I ended up working with one of the big investment banks, and my first foray into kind of anything that had to do with markets was in equity derivatives. So I worked on a Delta One desk, and we were trading like swaps and doing equity finance types of trades, and kind of like stock loans, structured derivatives, all sorts of things for institutional clients. And it was through that job that I ended up kind of getting my first introduction to ETFs, when we were kind of trading on the levered and inverse ETF products. And so I kind of stayed in banking for a little while, but eventually got the opportunity from the CEO of Direxion, which is the levered and inverse ETF provider, to kind of join them. They were doing something new in 2008. Heat of the financial crisis, 3 times levered bull and bear finance ETFs, and that was a wild ride. And I spent a decade like kind of growing up there, right? So I learned everything, everything from trading, sales, product development, research, capital markets, just kind of the ins and outs of running an ETF, managing an ETF. And we were all kind of like learning together, because at that point there really weren't levered and inverse ETF products besides one other provider. And pretty cool story. One of the guys who I hired to work on my team, basically like an institutional strategist going out to clients, teaching them how to, trade products. We worked together. We ended up kind of like spending a lot of time on the road, getting to know each other and whatnot. And he left to start Defiance, to start the company. And, so we always kind of knew that we were going to partner on something. And so, myself and a couple of other guys that he also had these, great working relationships with and partnerships with, are, kind of came together, and we're now Defiance. So, went from very much like institutional, very large ETF provider to startup world. And, we're really trying to get out there, do something new and innovative. Maybe a little big fish in the big sea, but I think we have a pretty big footprint. We try to definitely get out there, and we're all super just like passionate about what we do in our company and things like that. And so, yeah, so that's kind of how we ended up at Defiance. And we've been around for about 5 years now.
Wow, I mean, quite the experience. I'm very jealous of how young of an experience you had at ETFs. Like in high school, like, wow. I wish I kind of had that experience.
Oh no, I had no. I had the ETF experience didn't come until 2008, actually.
Okay.
So for a few years before that, it was just it was like it was kind of like trading, like scratching the surface with levered and inverse ETF products. Like they had just kind of come out, so nobody kind of like deeply knew them. But yeah, it was awesome.
Interesting. Okay, so can you explain the core mission of the Defiance ETF, especially with your past experience with working with ETFs for close to, what is it, 16 years now? Like, how does it stand out specifically within the crowded ETF marketplace?
So I think, the way that we started our company is that we knew that we were kind of, we had enough experience in ETFs and in being out in the markets where we kind of understood how people invested. And, we talked to a lot of portfolio managers and asset allocators and model guys. And so we knew kind of like where the, private high net worth money was going and things like this. And back then it was kind of like select stock sector indices in a model, like maybe all the State Street ETFs or iShares ETFs and whatever they might be. Like if you want tech, you just have some version of a QQQ type of product, or if you want S&P, it's SPY or IVV or whatever it might be. And, but we were also kind of like young enough where we were really interested in things like, Bitcoin, electric vehicle, like, some of the things that you like to cover, right? 5G, the future, like what is the future of tech, right? Like I don't want the same allocation that, my grandma has to just broad-based tech companies, that include like kind of the sleeper companies. I also want access to companies that are like super microcomputer and quantum computing companies and things like that. So the first thing that we did is we came out with thematic ETFs that track disruptive technology, disruptive sectors and innovation. And we priced them in a way where people like us could afford to buy them. So, our 5G ETF, for example, has a 30 basis point fee. It's the least expensive 5G ETF out there. Same thing with our quantum ETF, gives you that's like the AI machine learning play. It's 40 basis points. And so we kind of tried to make technology innovation accessible. And then we recently just, obviously you have to kind of diversify your assets. And so another big thing that people are really, kind of interested in right now is ETFs that provide some kind of income. And so we launched this enhanced income product suite where, we sell, options that expire in less than 24 hours on the 3 major indices and every day, and kind of, generate a large monthly dividend on NASDAQ, S&P, and Russell. So that's where we're at now. And yeah, it's cool product innovation that has, lasting power at reasonable prices.
I mean, I love that you said about the low fees, because that's always a trade-off. If you want to capitalize on these high growth thematics, the way the ETFs kind of get the investors is like, if you want this exposure and have this like diminished heartburn of owning these kind of volatile names, we're going to charge you big fees. So that's very unique, actually. Kudos to you guys for making that happen for the retail.
No, thank you.
So how do you identify and decide on which emerging tech to focus on? Because clearly I'm looking at ETFs and you guys are covering all the bases. You got the hardware component within the 5G ETF where you see all the semiconductor names. You have the EV ETF. You have the quantum computing ETF, which I fully believe after AI and even after AI, the next frontier is quantum computing. It's inevitable.
I'm totally with you on that. It's the buzzword that nobody knows yet.
Exactly, until they do, and that's when that's going to happen. So, how do you figure out these emerging tech to focus on? Because there's so much noise out there, but you guys clearly have identified the most meaningful tech trends you want to be exposed to.
Yeah, I mean, for sure we've taken stabs at things that also didn't work out, right? And I think that's something in this business that a lot of people don't admit. There's a lot of trial and error with these things. We might think that something is going to be, the next kind of hot technology, and it's going to change the way we live and work. And and I think that there were a lot of examples, right? Like I think like the blockchain stuff and that all of those things are going to come to fruition eventually, but all of the product launches that came out were a little bit too soon when they came out, right? So I think it's tough, and that makes innovation tough too, because you also have to kind of run a business and you can't leave products out there that don't generate assets and things like this. So there's definitely a fine balance in product, kind of product development, and it's a saturated market, right? But so the way, it's a lot of whiteboarding, it's a lot of going back and forth. I think, when quantum and 5G came out, it took a while to gain any kind of recognition or popularity. And, sort of two things happened. With quantum, we knew that something was going to change the way that we view technology. And we didn't know whether that would be machine learning. We didn't know whether that would be, healthcare focus, where it's, robots from afar performing surgeries and R&D and things like this, whether it would be artificial intelligence and chatbots, whether it would be, quantum computing. But we kind of had the sense that like all of those things together were necessary for each spoke to kind of work, right? And so we got to planning an ETF that really invests in or commercializes machine learning, artificial intelligence, and quantum computing. And then, we got this awesome ETF now, which really represents the marketplace for AI and machine learning. But to your point, also has the quantum names in there that people aren't thinking about, right? And just like, look at what happened to some of them, right? Like super microcomputer. I mean, that like stocks like that, you don't know when they're going to come around, right? And so when you look at an ETF like quantum, you have 70 names in there. You probably know half of them really well. You've probably not even heard of 10 of them. But as the space grows and develops, and you want to have your ballast with the large caps and take your, bets on some of the small caps that might have M&A activity, that might be the next super microcomputer and things like this. And so that was kind of quantum. With 5G, COVID is what really turned it around. So we knew, I kind of started out saying like our grandparents and parents had these portfolios, and they have just like Qs, SPY, XYZ Healthcare, XYZ Energy, or whatever it might be. And we kind of went down the row and said, okay, well, what's the future of tech? Well, to us, that's probably AI and machine learning. What's the future of just communications, right? And so for us, that was 5G and everything that is 5G. So it's kind of, it's what's going to power, Internet of Things, smart cities, kind of aerospace and defense, military, healthcare, just going to, connect like low latency for AI research, just kind of like everything that has to happen in order for technology to move forward is driven by 5G, right? And so we thought, that'll be the next communication sector that people want access to. And then a really interesting thing happened with that ETF. COVID hit, and we were all stuck at home. All of a sudden, nothing mattered more than low latency communications, cell phones, cell towers, the REITs being connected to be able to trade. And that ETF really took off around then. And then the same thing, hydrogen, you can kind of just extrapolate it, right? So like hydrogen would be the next way that we power kind of like clean power energy. It might be something that, people really look to invest in. You keep hearing the crypto miners talking about it and how they're trying to figure out how to use hydrogen to power their mining. But a lot of countries actually, have fuel cell vehicles, buses, boats, and stuff like that. And we thought there'd be something interesting there. And then, EVs, like the top 5 EVs is something that we looked at. And then even like just creating something that's efficient. So we have, our other thematic play is called cruise, and that's just airlines, cruises, and hotels together. Cause we just thought like, if you're kind of doing one, you're probably doing the other, and nobody really laid it out that way. And we saw space there. So we kind of jumped into it, but that's how that's kind of how we go about it.
I mean, I always reference this, like, yes, we're going to talk about the economy right now, but nobody's really talking about the digital economy that's about to happen next decade. And a lot of these things you're referencing, they're going to be the pillars of this digital economy. And you're front loading it clearly with the performance in your ETFs the past year or two, or you're seeing all these in your 5G component, like ETF. Let me get the ticker for you guys. Ticker FIVG. You guys front loaded the first stage of adoption within this digital economy, where you guys went hard on the hardware component, which if anyone knows of like the stages of adoption of any new tech, it's always the hardware. That's the first stage. And clearly that's been validated in the past year or two. You look at the semiconductor performance and this ETF performance, like, wow, it's outperforming the market by an easy cushion. Yeah. So I want to ask you, like, because I see in this ETF, you have NVIDIA, you have all the big boys like NVIDIA, AMD, Broadcom, Qualcomm, and they all are heavily exposed to potential geopolitical risk just because, as you know, like it's an election year. One specific candidate, Trump, is gaining momentum, and he clearly might reignite a China trade war, which might create some more noise on. And combined with like the recent bill of TikTok being banned, there's a lot of like worry potentially of like how is China going to respond. And the biggest vulnerability we have as a U.S. economy is if they do something with our semiconductors or like some kind of TSM, like Taiwan Semiconductors, something with that will have a huge ripple effect across the whole digital economy. So how do you kind of go through that landscape of protecting yourself with the geopolitical risk using these ETFs?
Yeah, and so that's a great point. I think you mentioned China. I think the last I read, they consume about 30% or so, I want to say, of global semiconductor business, if not more. And it will be more, right, when they get their population, when they get that like middle class population, which everyone thinks is going to, kind of like double in the next 5 to 10 years. That's it's a huge group of people who consume electronics and technology and things like that. So it's a great point. So what we do with our indices is we create an index and we run the ETF where it tracks that index and it's rules based, right? So we're not like, we can't be active stock pickers. We have our rules, and the rules are that the company has to generate all of their income, their R&D, their commercialization of products has to do with and be, in full integrity along with what is 5G, right? Mm-hmm. And so we pick the top names in those spaces, and they have different sectors. And, as you said, a lot of it's hardware, some of it's semiconductors. But what I would say is the ETF is well diversified. So, even if you took the semiconductors out of it, you have all of the kind of like, the telecom, you have the communication REITs, you have the routers, you have, other types of companies essentially that'll give you access to the 5G space. And to your point, though, clearly it's outperforming because of the semiconductor names, right? There's no doubt about that. And if we look at what happened already, there's already issues with semiconductors in China, like regardless of whether Trump gets elected or not. And so a lot of these companies have readjusted their chips to comply with the rules. And so I suspect that, if things kind of go down a bad path for semiconductor companies in particular, they'll probably have to produce chips that are compliant. My sense of it is that globally our chips are very much needed, right? And there is no competitor to NVIDIA yet. And so, perhaps they have to spend money and do R&D to comply with different rules and things. But yeah, it's a fair point. It could be a risk. And I think that if semiconductors crash, you're definitely going to see a pullback in tech again. And it's going to be like a 2022 year. So, you would just hope that that doesn't happen. But the way that we mitigate, not just hoping for it, is to have these well-diversified products that track stocks in other sectors too.
Yeah, you absolutely are right on how you guys diversify your ETFs. Like, 'cause I'm seeing some REITs here that capitalize on the data centers, but also gives a guaranteed safe haven of like guaranteed income through their dividends. And you do balance that perfectly with like also the Verizons, AT&T, and all the semiconductor plays. I am very curious because I'm a huge believer in AI, and I do think that's the second stage of this AI movement is through enterprise software. And I'm noticing Datadog is the one you guys have the most exposure to right now, specifically on the consumption model for enterprise software. So hoping you can like call out why that was your favorite name to get the most exposure to for the enterprise software space within this ETF versus like a Snowflake or a Confluent, a MongoDB. Is it because you see data exploding and Datadog specific mode is observability? So like, that's going to be an absolute necessary element of this data explosion within the digital economy next decade.
Yeah. And so like with us, again, it just goes, they're index tracking products. So we basically have this index methodology, and it basically tracks, kind of the top 48 names in the 5G space by market cap. And so the names that get picked up are the names that are the top in their sector, essentially. So, whether you have like core carrier, mobile networks, enterprise software, wireless tech, whatever it is, it's going to be those top names within that sector based on market cap that get put into the underlying index. So it's just essentially it gets picked because it's picking up on the rules. And but the other names could certainly end up being in there too, if they kind of supersede market cap or something like that. But it's all just index based and rules based. Beautiful.
I think we should pivot from the 5G ETF because we've definitely had a lot of time that, and you have a lot of other great juicy ETFs. Let's go into the quantum one, actually, QTUM. Yeah. Interesting. The biggest holding is MicroStrategy. And for all the crypto lovers, this is an interesting way of gaining exposure in the quantum computing thematic, but also participating in the clear crypto trend we've noticed in 2024 that's continued from last year. So wanted to get your thoughts on, has this crypto rally surprised you on how aggressive it's been, where it's clearly fighting the tape on any kind of volatility we're seeing in the growth names the past month of like them consolidating, maybe even fading, where crypto is just hitting all-time highs consistently week by week. And it's kind of defying a lot of common knowledge of like they're linked to growth names, but growth names are pulling back, crypto's raging. So there's a huge disconnect now. So I want to hear your thoughts on like how that is. Did that catch you off guard, the crypto rage that we've experienced? And do you think we're going to hit 100K this year in Bitcoin?
So I thought that, you know, when we were right about at this level, I actually thought that we were going to hit 100K then. And the reason why is because of all of that, what has just happened now could have happened back then, but it kind of didn't. So I'm not surprised with, you know, I think for a while it was, so it's super interesting because if you look at like the tech bear market, like a 2022, most of the time, because I was often asked about this on a pretty regular basis, like, why do you think crypto's down? And then I would look and it felt like that. It felt like a risk off trade, right? Like all the tech stocks were down. And so crypto feels like it almost trades like this growth stock and it's risk off. And I mean, you know, risk off. And so it's also suffering alongside of those stocks. The correlation is pretty high. But then, you know, for a long time, we thought it was going to trade like an alternative asset, like gold, a commodity. And then to your point, now there's this dispersion. And it's actually not trading like the high growth stocks. It's trading like its own thing. And so what surprised me about it was kind of that, like crypto has come out as its own asset class now, and people are looking to allocate it. So I'm not surprised at all that the price has gone up, just because like if you just look at the flows into the various ETF products that launched, I forget if there are like 11 or 13 of them or however many are there. And you know, we'll see how many are left, but there are just billions and billions of dollars going into these products. Whether it's, you know, through crypto directly or whether it's through the ETFs or, you know, some version of both. And I think, you know, you have this institutional adoption, you have people who are simply, you know, buying crypto because of the price action now and you know, fueling the trend it's having. It's, you know, I think so much of it, though, the catalyst for so much of it was the approval of the ETF product. Because I think we take for granted, like, I mean, I've traded crypto forever, right? Had a digital wallet and whatnot, but a lot of the clients that I talk to say things, you know, like, I could never manage crypto. I could never manage a crypto investment for my clients. Like, there's no way I'm going to manage all of these digital wallets and Coinbase accounts and all these things. Like, it's just not efficient. And so the ETF wrapper, you know, we kind of know the story there, right? But for people who want the efficiency, the ability to get in and out of it in a second and like see the trade on their books, have their compliance groups review it, all that kind of stuff, like the ETF just helps a whole lot there. And so I'm not surprised that it supercharged the price of crypto. And I think now, I don't know if we're going to hit 100,000 this year. I would say no. I think we eventually get there, but you know, a lot of times what happens with this is like you have halving, right? And then so trades ahead of that, it's traded ahead of the ETFs, and then it falls back and then it picks back up. So I think you'll have some, I think it'll maintain its price. Like, I don't think it's going to crash this year, like, you know, back to the 30, 40,000 range, whatever it might be. But I think, I think you'll get decent appreciation, but I don't know if it tops 100. What do you think?
No, I mean, first off, I don't want to say it wouldn't, because there is a cult following on crypto who will just come at me probably if I say it's going to go down.
So it's definitely going up. we don't know, right? We don't know. Like, I mean, momentum is really, really good, and it'll get
100%.
there, I think. I just don't know if it'll happen before January.
But I think you nailed it, though. Like, there's an intangible element that happened in crypto this year, where it used to be a vehicle to capitalize on a risk-on trade. Yeah. And like, if you think it's going to ARK is going to go up 5%, crypto is going to go up 10 to 15%. So that's how you use that trade. But now it's, ever since the ETF approval, it's kind of just going away from the crowd. Like, this is its own strategy, not like a vehicle to capitalize on risk on. Like, this is a completely separate thing. And I think the validating that is a huge adoption curve that they're finally getting over and past for the large scale audience. So
Yeah, totally. And then also, like, if you think about the average person who, you know, is open to thematic investing in new things, like, I think, you know, most of the people that we talk to are like, it's rising so high. I don't know if it's going to be commercially usable, or if it's going to be an actual currency that we use to buy a Starbucks coffee with, or if it's really going to, you know, be this protective currency, whatever it might be. But the price is just parabolic, and so I'm willing to allocate 1% to take the chance that it is this performing asset class. So I do think you have a lot of people with just a willingness to trade it now too, that don't even know much about it.
I mean, I have some crypto bulls as friends, and they always tell me, what's 1% going to hurt you? Like, just have that 1%
Yeah.
exposure.
Yeah.
Because, like, if you're wrong, that 1% is going to save you almost.
Yep. Yeah. It's true. It's a good point. It's a good point.
So, funny thing about like the AI thematic, like everyone thinks it's brand new, but it's been around for like 5 to 6 years. Like they just use a different word. It was large data analytics. It's always been around, but the huge movement of it was the inflection point was ChatGPT, LLMs, and that's once they started validating the ROI for clients, like on the enterprise side, they really ramped it up, and it was a clear inflection point of like acceleration, similar fashion of e-commerce during COVID. And like you just said, 5G during COVID. Those are inflection points on these thematics.
Yeah.
So what do you think that the inflection point of the quantum computing thematic is going to be? What kind of news stories are you looking for, specific like levers that you're going to be monitoring to see this is that inflection point, similar as 5G, e-commerce, and even AI?
So I predict that we're pretty close. And the reason why is because, you know, as you said, the inflection point of AI was ChatGPT, right? And now we're starting to see that these chatbots are making a whole lot of errors. And they're awesome, right? But they are making errors. They're not completely efficient. And why are they not efficient? You know, part of that is maybe programming, but part of it is also, you know, data, right? They're only as good as the data that they have. And so quantum computers allow you to have massive amounts of data that is processed efficiently and quickly and things like this. So I think that in order for AI to move forward, particularly as it relates to things like ChatGPT and those types of experiences, and then even like drug trials, if you think about like all these weight loss drugs, and all these companies are like now like really, it almost feels like there's this renaissance in you know, biotech and pharma, and that's been sleepy forever. And I think they're starting to use AI, right? And so again, you're going to need more information, parallel types of information running at the same time. And I think that supercomputers and quantum computers do those types of things. So I think that's number one. Number two is there are many bad things going on in the world, as we know. There are, you know, 2 very active wars, for example. And so I've been reading a lot about companies like IBM, for example. Like they're doing these projects with South Korea where they're trying to, you know, better pinpoint targets and you know, kind of like outcomes of defense strategies and things like this. The U.S. government put about $5 billion into quantum computing for this, you know, kind of same thing, right? And then China put $15 billion into quantum computing for the same thing. So I think it's going to come from perhaps defense government spending. I think like drug trials, pharmaceuticals research, cancer research, these things, or it's going to be like the fixing the ChatGPT moment, you know, the marked efficiency of that. Yeah, I think we're on the cusp of it.
I mean, I agree with that sentiment. I think once people not realize, but like the LLMs are going to be a commodity where it's not like OpenAI is being valued this much, but at the end of the day, it's just a commodity, in my opinion. Like once as time goes on, a lot of people are going to have similar competition. Quantum computing, all eyes will go towards that because that's really where the moat, high barrier of entry is for the next thematic. Since we're so in the early innings of this like quantum computing thematic, what's your perspective on like the small cap players within it? Where IonQ is a perfect example, where that's like a retail favorite for quantum computing. Where do you think those kind of smaller players have a shot at the IBMs, the NVIDIAs, who have just been around for so long, who are just like have so much freedom to make these pivots. Do you think they have a real chance? Because that's the biggest like fair argument for like the smaller names within the quantum computing space is, can they compete against IBM? Like they're worth $2 billion. IBM's worth over $100 billion.
Yeah.
Do they have a fair shot?
Yeah. So the interesting thing about the small caps is some of them definitely do. All of them do not. Right. And the what, like, again, like think like, look what happened to super microcomputer, like that kind of came out of nowhere. And there's other companies like that, like small cryogenic types of providers that I'm now watching because of that stock, right? That are like these tiny companies that nobody's ever heard of. But I think, in our index, we thought that, again, like you need the ballast, you need the leaders in there, because to your point, the barrier of entry is so high. Like you can't just go build a quantum computer, right? Just what goes into building a quantum computer is wildly expensive, and then how you maintain it, cool the room, all of these things. Like this is a multi, billion, trillion-dollar market cap company type of project, right? But company, like if you just look at what happened with AI, you have Amazon with the Anthropic investment. You have Microsoft ChatGPT. Like these large behemoth companies will find the small caps that, support the business that they're trying to do and allow them to do things that they haven't done as well within that space. And so I think that there's M&A opportunity, and then there's a couple of them hitting it big. But I think what's great about the way that we think about it is you're not really going to get hurt if the small cap companies don't all take off, because you have all those large caps in there, but you're really going to benefit if they do, because chances are that the large caps are also running. So we really, it's almost like a premium on top of the ETF itself to have those small caps in there.
Oh, I absolutely agree with you on that. Before we move on to the next ETF, because this is the one I want to talk about, the EV one, which is not getting the love it deserves and the cyclical nature of their business. But going back to the last question on quantum computing, I always made this reference that it might be totally unfair that Apple's been sitting on their hands since, unfortunately, Steve Jobs passed away, and Tim Cook's just been like leveling out, like cash machine. We know our niche. We're going to stick with it. We're not going to really take that much risk besides the Apple Card, which they scrapped. Are you surprised they're not making more of a play for quantum computing? Because technically, it's a capital-intensive type of project, which we all know they have so much cash. And they're kind of more of a hardware company at the end of the day, where they create this hardware and they create this massive ecosystem around it. And we're clearly going to be seeing that with the Vision Pro next couple of years. But are you surprised they're not really having more of a presence within quantum computing? Because I thought that would be like a natural synergy for them.
Yeah, I thought so too, and I could almost like picture it if you walk down the street, you have some huge glass room with freezers around it or something, then they would, the way they present the display of it or something would be quite cool. But you never know with Apple, right? I think a lot of people are kind of counting them out now. The stock price is falling. It feels like they haven't done as much as we hoped for in AI, and it still feels like an iPhone story a lot of times. But then they come out of the woodworks with things all the time, right? And so I think that we can't count out that they are working on something. Maybe they're not far along enough. Maybe it's not working. But it's actually a really great point. I haven't heard them talking a whole lot about it. So maybe it's kind of like not on their radar. But you would imagine that between their investment in their own chips and laptops and things like this, and it could be on the radar for them. But yeah, I mean, look, I think if it comes to, like, as far as I know, IBM and Google are kind of the leaders there. So when you think about like IBM wouldn't be my first thought of who is innovating with supercomputing. So we'll have to see, right? We'll have to see. It's still unclear to me really where Microsoft and Google and Amazon are with AI. It's still unclear to me, who the winner is going to be. Like right now, it feels like we know who dropped the ball and who didn't, but we don't know what's going to happen long term.
No, I mean, you absolutely nailed it. Apple really keeps their information tight to the chest. Like they don't really reveal it till the last second. So who knows? Maybe tomorrow they might make the announcement. But moving on to the next ETF, which I for sure think is probably the best value available in the market right now with everything else has ran up. It's the EV component, ticker EVXX.
Yeah.
Uh, saw the holdings in there. Very interesting that there's a lot of exposure in the China market and also as well as Tesla and Rivian.
Yes.
So the way I want to reference it is hardware and EVs, they're both heavily cyclical industries. We're clearly seeing one end of it on the semiconductors of like, wow, everything's thriving, margins super high, couldn't get better. Then we're seeing the other end of it where EVs, wow, it could not get more worse news. Like every single week, we're
Yeah.
just seeing bad news hitting that industry. Consumer discretionary spend has kind of been diminished the past year or two. People are just worried about paying rent, not worrying about what car to buy or being more conscious about EV by trading their car in for a newer model. There's just so many headwinds in the EV industry, but it's surprising how short-sighted some of these investors are. Like, do you really not think we're going to be inevitable? We're going to be all driving EVs by 2030? Like, that's going to happen. Like, it's one of the highest floor assumptions I can make where like it's going to happen. I don't know when, but are you surprised with like for specific Tesla of like how people aren't having that long-term mentality of like, they just won the supercharger network. Like all their competition waved their white flags. They gave like, we're going to use it. We couldn't figure it out. And they have the pricing power of like killing their margin in the near term, but they want as many cars as possible out there because the full play for them is the software element, the FSD, because you can really upload it to across so many cars and that's a high margin business. So are you shocked that like there's a lot of short sighting type of investing right now in the EV space where like this ETF is down 26%, but you're technically outperforming Tesla, which is down 33%. And Tesla is the king of EV. So like other names on semiconductor, air test systems, they're down like 40%. So you're outperforming those names, but are you surprised with like how aggressive the self has been in EV and like the lack of long-term vision in that kind of space?
Yeah, and I mean, so I hate to be the bearer of bad news, but because of that, our ETF has just been sold down to zero. Basically, our ETF is closing. We announced that recently, but it just, when we launched it, it took off. It came out of the gates, and then people pretty much traded it down to nothing, right? Because to your point, the performance, I suspect, is just not. I think investors have low appetite for holding things that don't perform, even if that's going to turn around, right? Like the right thing to do if you really have conviction in something like Tesla is to dollar cost average your way back into that rally that will someday come. I totally agree with you. But I think that, just trading behavior and things like that don't usually work out that way. And so, what I think that we've learned, I mean, from an ETF perspective, I think we've learned that people investors based on where the AUM is going, they either like pure exposure to Tesla, leverage exposure to Tesla, or a basket of stocks that represent EV. And that's everything from companies like, Apple to NVIDIA to the actual EV companies themselves. And like, kind of like a quantum, a diversified basket of stocks. And there's a whole lot of those out there. But in terms of the innovation itself, I completely agree with you. I think that it's a blip on the radar. People kind of don't want to spend the money. I hear a lot of arguments against EVs now in terms of like, they're so hard to charge and people still like, they're just not going to become commercial enough because it's still too difficult to just get in the car and go without worrying about planning out like where you're going to charge and all these things. But I think the macro picture, like we're trying to better the environment, right? There's been this global demand pickup in electric vehicles around the world. It's slowed, but it hasn't, it's still continuing to slowly grow. People are still buying EVs, right? It's just at a slower pace. And so I think that, inflation comes down a little bit. You can get perhaps if you're a young person, because young people, I think, tend to believe in EVs as well. Might be willing to buy that type of car. I think that as it improves and you get more information about, the charge lasting longer, things like this, I think it'll kind of pump back up, right? But it's interesting. You mentioned this during the semiconductor topic that we talked about, like, kind of like who gets elected president matters a little bit for this too, because I think, there could be this feeling that, there aren't going to be any kind of like credits, or there won't be any, necessarily support for EVs with one group versus the other and things like that. So it's also a political thing, I think. But in the long run, I agree with you. Like I was telling you before, I have a little child screaming in the next next room. I mean, I have a 2-year-old and a 4-year-old, and I often think, like, by the time they're driving, will anyone have will the gas powered car be the anomaly? And I do think it's possible, but yeah, I mean, for now, it's just not getting doesn't have any wind in its sail, unfortunately.
Yeah, I mean, I agree with all your points. I want to kind of tackle the small cap topic, because
Sure.
there's very few individuals like yourself who are very open publicly talking about small caps. And I kind of want to take advantage of that time, because I'm also a small cap investor. I have a portfolio on it. And I'm even caught off guard with this kind of movement it's had, where entering this year, I did not agree with this assumption, but 5 to 6 rate cuts in 2024. That was the expectation entering the year. As we've gone on, like we're almost through Q1 of 2024, it's now turning into a 2 to 3, most likely 1 to 2, based on the data we've seen. But you're seeing the resilience in small cap, where IWM is like still at 206, 207. They've kind of been stronger than the SPY, QQQ the past week or two, even with this like hot CPI print, and like the data is like showing things are going great. Like, why would the Fed need to cut rates? Are you surprised by the resilience of the small cap? And if not, why do you believe they're showing such strength when past performance has them being highly vulnerable to any kind of rates cuts? And clearly we're getting the odds diminished from 6 to 3, and it's going higher. So wondering what your opinion is about that.
Yeah, I think, it's just interesting, because as a market, and myself included, we've all been obsessed with, every meeting, every print and whatnot. So if we look at this last print, what's interesting is that, goods have gone up. There are a couple of areas of the market that have gone up, but some like things like healthcare have gone down, right? And so healthcare is a major component of PCE, and that's one of the Fed's more favored measures. And then overall with inflation is coming down. It's just that you have some blips in the radar. January makes sense, right? You have just too much seasonality to get that number down, I think. And so now we have another month. I think we need to see what happens next month, and then and kind of the month after, right? If we continue to get readings that are a little bit higher than we expect, then we have a problem. But overall, year-over-year inflation is down. Year-over-year, the cost of gas and food and things like this are down. PCE is trending in the right direction. The jobs numbers are hot, but if you kind of also strip out seasonality, and you also kind of look at the adjustments that they make to the numbers they announce just about every month, it does look like it's kind of starting to stabilize. And so, I don't think that, first of all, I never thought the Fed was going to cut 6 times. It was just not, it just sort of seemed hard to believe. There wasn't this huge catalyst where we went from like, 7 to 2 or something like that. I don't know. It's been a slow burn on the way down, and they want to get to 2. So I think, we're not there. We're going in the right direction. Fed doesn't want to crush the market, but, maybe we get 2 or 3 cuts. But I think, to answer your question more specifically about small caps, the cuts are coming and hikes are not coming. And with small caps, usually, the rule of thumb is like you start buying small caps when there is an actual cut. And I think investors now have a little more patience with that, and think to themselves like, okay, these numbers are a little bit unclear, but like, we just don't think we're going to have a rate hike. If we have a pause longer than we expect, and don't get that cut as quickly as we expect, then small caps are going to kind of, muddle along. Maybe they'll get a little bit of performance, but then, once it happens, they tend to start taking off. And of course, because they can support their businesses and their growth, they can borrow money and things like this, right? So I think it's just a matter of time. And there's so many little, good nuggets in small caps that have been asleep for a long time that I, kind of can't wait to see how they perform.
I know they're all priced for dead, like as a bucket, which was absolutely wild in the past 2 years. I fully agree with all your points that you made. Like I also think that if it doesn't happen by June, July, I don't think it will happen in 2024, just because of the election. And usually they pause around that time if there's no actual initiative or launch. So do you anticipate like what do you anticipate if the rate cuts don't happen by June or July, and potentially the only chance it happens maybe once by the end of Q4? But how do you think the market would digest that information? Because clearly nothing can shake this market right now. Doesn't matter if the hot print or like the rate
Yeah.
cuts or anything Fed. So,
And to that point, like I also, to the point of the election year, like I know we're not like bumping right up on it yet, but I just don't think the Fed's going to crush the market this year.
yeah.
I don't, for whether it's for political reasons, whether it's for, economic reasons, because I think you can argue both sides of it, right? Like if you leave rates too high for too long, at a certain point, it does become detrimental to the economy. And that is not something that just shows up in a month, right? It'll start to show up over time. And so I think, Fed Chair Powell knows that. He acknowledges things like that. And so I think my prediction is it's an election year and we'll see a cut. I don't know that we'll see 2 or 3, but I think we'll see something on the tape before the election. I'd just be really surprised if we didn't.
I agree with you. I hope that happens because in my experience,
unless the next print is like 0.7, we're done. But then the market's going to crash. The market's going to pull back, and that's going to be, a big disaster, and then it'll revert to the mean in 3 months.
I know that's so true.
Yeah.
I hope you're right because in my opinion, Fed always overstays their welcome on both ends. So hopefully they break that trend this go around. Well, we're towards the end of our interview, but I have one more question.
Okay.
Where can our viewers go learn more about Defiance ETFs and like stay updated with your latest offerings? Because clearly, you guys are in the high thematic growth thematics for next decade, and that changes. That's not like a consistent right now it's quantum computing, but maybe the space economy is the next one. Who knows? Like, how can we stay updated with your latest offerings?
Everything's on our website, defianceetfs.com. We're on Twitter, we're on LinkedIn, we're on Instagram. We're talking to you, so I think we're pretty easy to find, and I'm very much reachable, and everybody can always kind of reach out to me, and we'd love to tell you about what we're doing, hear about what you would like to see done that isn't out there. We love hearing from everybody. So, but yeah, website's defianceetfs.com.
Awesome. Well, thank you, Sylvia, for joining us. Can't wait to see the rest of this year continue. Hopefully the trend from the first 2 months will continue the next 10 months.
Thank you. I hope so too.